Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of the Walt Disney Company, ticker symbol DIS. So we're looking at Disney today as a subscriber request. Disney made headlines recently when it announced that former CEO Bob Iger has recently stepped in and is now going to be the CEO for the business again. So that came out in late November 2022. While Disney's share price did shoot up on the news, they've since come down back to around where they have been before that. So right now, Disney is trading for about $90.44 per share. We're recording this video while the market is still open, so their share price is going to bounce around just a little bit here. Currently, Disney is down 37.5% over the last year. Over the last 5 years, Disney is down 14% overall. Over 10 years, however, Disney is compounding at a rate of 6.5% annually. And going back prior to the global financial crisis, over the last nearly 18 years, Disney is compounding at a rate of about 7% annually. Keep in mind that they did pay out dividends over most of this time, although currently they're not paying out dividends. So their average dividend yield throughout this period would be in addition to their compounded annual return. So Disney is currently trading about $4 above their 52-week low. They're down more than $70 from their 52-week high. Disney is a very large business. They're one of the largest companies in the world, and they have a nearly $172 billion market cap. For more background about the company, Walt Disney owns the rights to some of the most globally recognized characters, from Mickey Mouse to Luke Skywalker. These characters and others are featured in several Disney theme parks around the world. Disney makes live action and animated films under studios such as Pixar, Marvel, and Lucasfilm, and also operates media networks including ESPN and several TV production studios. Disney shifted into a more streaming-focused firm by acquiring the remainder of Hulu and launching Disney Plus and ESPN Plus. Across its streaming platforms, Disney had over 235 million subscribers as of September 2022, up sharply from under 64 million in December of 2019. Further, the company sells branded merchandise through retail, online, and wholesale businesses. The Walt Disney Company was founded in 1923 and is based in Burbank, California. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Disney based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So over this time, Disney's return on capital has come down pretty dramatically. They had about 19% returns on capital in 2018, and really they had quite a steep decline going all the way until their fiscal 2021. Since their fiscal 2021, their returns on capital have been increasing slightly. Over their last 12 months, they earned about a 4% return on capital. However, averaged out over this period, Disney was only earning about a 7% return on capital, which the reason we were looking for 14% here is because the average publicly listed business only earns about a 7% return on capital. And over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns. And these business returns are going to be captured here by return on capital. So by looking for 14% or higher as our benchmark, we could potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. In the case of Disney, they're only earning returns on capital of about a typical business here, and it's pretty lumpy to boot. This means that this is going to be an X to start things off on metric number 1. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years, and this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. Over this time, Disney has grown their revenues by about 40%. Their earnings, however, are down over this period by more than 75%. They had negative earnings in their fiscal 2020 as their theme parks closed, and Disney's theme parks were a major contributor to both their earnings and their free cash flows. Additionally, over this period, their free cash flows are down by about 90%, with Disney just bringing in about $1 billion worth of free cash flow over the last year or so. So both their free cash flows and earnings are down, even though their revenues are up over the last 5 years. So this is our second X in a row here on metric number 2. Then next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Disney on a per share basis. So we're looking for earnings per share growth over the last 5 years. We learned in the previous metric that their earnings are down over this period, and at the same time, Disney has diluted shareholders by about 21%. So they've issued 21% additional shares over this period. This is likely disappointing for long-term shareholders in the business because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business dilutes existing shareholders by issuing new shares, they're decreasing your ownership percentage of the business, which will ultimately decrease the percentage of the business's profits that you're entitled to. It's really been a 1-2 punch here that their earnings are are down so dramatically, and they've also diluted shareholders by about a fifth over this period. This is yet another X on metric number 3, and we're not starting things off so hot for Disney so far. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Again, their free cash flows are down pretty dramatically by 90% over this period, and in addition to their shareholder dilution, their free cash flows per share are down as well, so this is yet another X on metric number 4. One potential positive sign is that Disney has kept their free cash flows positive in all 5 of these years, even though their earnings did go negative in 2020. But as their free cash flows have dramatically declined recently, both through lower earnings through their theme parks and more spend through their direct-to-consumer streaming models, other parts of Disney's financials have suffered for it, such as them having to cut their dividend in recent years. So again, to recap where we stand currently, through our first 4 metrics, we have 4 X's so far for Walt Disney. Then next up for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that Disney has produced over the last 5 years. So Disney added on quite a bit of debt between 2018 and 2019. They ramped this up to a high in 2020. However, since then, they've been paying this down somewhat. Currently, Disney has about $40.6 billion worth of net debt, and over their last 5 years, Disney has produced about $18.2 billion worth of free cash flow. That would only support about half of this debt load with those free cash flows. Again, their free cash flows have declined pretty dramatically, especially since the COVID-19 pandemic, and over their last 12 months, they're only earning about $1 billion worth of free cash flow. So this is yet another X here on metric number 5. We're still trying to find our first check of the day. Even though Disney seemingly has a very high debt load in comparison to their free cash flows, given the nature of Disney's business and the overall durability that it likely possesses, this may not be potentially as much of a concern as it would be for some other businesses that wouldn't have some of the moat that Disney has around their business. Again, Disney as a company just has a ton of iconicness associated with their brand, and they own some of the strongest brands in the entire world. But things certainly seem rough so far just looking at their financials. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this would potentially give us a slight risk premium to the yield of the 10-year treasury and potentially give us another reason to be interested in Disney. We're using their total enterprise value because it's going to take into account both their market cap and their net debt position, and it's going to give us a perspective of the economic reality of the business that's going to be more similar to as if Disney were a private company. So right now, Disney has about a $227 billion total enterprise value, and we learned that over the last 5 years, Disney has produced only $18.2 billion worth of free cash flow. This means that in an average year, Disney is only producing about $3.6 billion worth of free cash flow. So when we divide their $3.6 billion of their average free cash flow by their $227 billion total enterprise value, that only gives us about a 1.5% average free cash flow to enterprise value yield. So that's less than half of the yield of the 10-year treasury, and that's well below that 5% risk premium we're ideally looking for. This is also an X here on metric number 6. Also worth pointing out, again, as we've learned over their last 12 months, Disney has only produced $1 billion worth of free cash flow. So right now, their current free cash flow to enterprise value yield, when we divide their $1 billion of their last 12 months of free cash flow by their $227 billion total enterprise value, is coming in at less than 0.5%. So that's a very small current free cash flow to enterprise value yield. It doesn't look like we'd be getting the risk premium we'd ideally be seeking on either a current or an average basis of Disney's free cash flows. With an X here on metric number 6, Disney has gone 0 for 6 on our Select 6 analysis today. Then as a bonus, here we're looking at the history of Walt Disney's dividend payouts over the last 5 years. Disney stopped paying out dividends after their fiscal 2019. They did support their dividends in 2018. However, they only paid out dividends that were unsupported in one of these years, and they have not paid out dividends since their fiscal 2020 or onward. It would seem to be the case that Disney's cash flows would have to rebound pretty dramatically from where they're at currently before they would consider paying out a dividend again. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Disney, which takes us on to using a discounted cash flow model to come to a potential fair value for Disney. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with an average of Disney's free cash flows over the last 3 years. Then we're using historical growth assumptions for how the business has been able to grow their free cash flows dating back all the way until 1990 to give us a baseline projected estimate for Disney going out over the next 20 years. So it's up to you to do your own homework here to understand if these assumptions are going to be potentially accurate or applicable going forward for Disney. So assuming a growth stage over the next 10 years where they grow their average free cash flows at a rate of 5% annually, then using a terminal stage for the 10 years after that where they grow these free cash flows at a rate of 4% annually, if we add in their tangible book value today and we were ideally seeking a 10% rate of return from Walt Disney, then it looks like a fair value for their business is only around $16.50 per share. Please, before making any sort of rash judgments, keep in mind a couple of caveats. One is there are a number of reasons why this might not be potentially accurate. Disney seems like it's facing a lot of headwinds currently, and it's possible that these are just temporary and that the business's cash flows would rebound at a rate that's much faster than this. Their free cash flows are pretty depressed from where they have been historically when things were clicking on all cylinders for Disney. And two, there are a lot of qualitative aspects about Disney's business that aren't going to be captured in its financials here, which again could potentially lead to outperformance and at least lead to very strong durability for the business over a long period of time. Please be mindful that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a moment, we'll talk about a recap for Disney, but we have to address something first. What are some of these qualitative aspects about the business, especially those that would pertain to a potential short or a potential long thesis for the company? So starting with some of the key points around a potential long thesis for Disney, number one, although making movies is a hit or miss business, Disney's popular franchises and characters reduce this volatility over time. Additionally, the firm's annual slate does not generally rely on one big picture, reducing the downside from a potential flop. Number two, Disney Plus has a long runway for growth available in both the US and internationally. The firm's original series and the deep and consistently expanding library will drive that growth. And number three, the parks and resorts segment will rebound strongly from the pandemic as families still view the parks as a prime vacation destination. Then for some of the key points around a potential short thesis for the business. Number one, developing mass market hit programs can be unpredictable, especially as media fragmentation continues. The race to attract and retain talent creatives has been and will remain very competitive and expensive. Number two, the streaming space is becoming increasingly crowded. Disney may need to continue to fund losses at this segment beyond fiscal 2024. And number three, the business model for the media networks division depends on the continued growth of affiliate fees. Any slowdown in the growth of these fees as pay television subscribers continue to decline could tremendously hit their profitability. Hopefully that offers a balanced perspective around some of the key points around a potential long or a potential short thesis for the business. Now let's get into our wrap-up. So in summary, Disney is going 0 for 6 on our Select 6 analysis today. They finish with 0 checks and 6 X's. Disney earns just about average returns on capital that have been pretty lumpy over the last 5 years. One bright spot for the business is that their revenues are up 40%, but over this period, both their earnings and their free cash flows are down pretty dramatically. They've also diluted shareholders by about 21%, with their free cash flows coming down by more than 90% over the last 5 years alone. Disney looks like it's employing a lot of debt in their business, especially relative to their current free cash flows. And both on an average and a current basis of their free cash flows compared to their enterprise value, it looks like those yields are not giving us the adequate risk premium we'd ideally be seeking in comparison to the yield of the 10-year treasury. Then Disney cut their dividend in their fiscal 2019, and they have not paid out dividends since. And finally, performing a discounted cash flow analysis of Disney. If you've done the work and you believe those historical growth assumptions, it looks like a potential fair value for the business is only around $16.50 today based off of their abilities to produce free cash flows over their last 3 years. So again, this is massively depressed from where they've been at historically. And so there are a number of reasons why this might not be potentially accurate for the business. So it's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding of Disney to help you determine whether it's worth your time and energy to dig in and learn more about the business. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So as a value investor, you ultimately want to research a business as if you're going to own 100% of it, and you can truly understand the ins and outs of that business and understand what's important and what's not important for the company going forward, and truly know the essence of the business. So through this deeper research into Disney, you'll learn more about the qualitative and the quantitative aspects about the company, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the business will be. So with that said, that's it for today's fundamental stock analysis of the Walt Disney Company, ticker symbol DIS. Again, we looked at the business as a subscriber request today because they've been in the news recently with their CEO turnover and with Bob Iger stepping back into the position of CEO. So if you enjoyed today's video or if you learned something through the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Disney with me, and have a great day.